So now I am actually recording this thing. So let me go ahead and bring up my slide and then we'll get started. So okay, so can you see my slides? Okay, so this presentation is on implied volatility, and again, it's from that book that I've been reading from the Tasty Trade team. And what I will just say is this is not designed to teach you everything you know about implied volatility. It should just give you enough information to use it to our benefit. And what I said the other day was if you learn or take the basics out of this, you're going to be ahead of probably 90% of option traders. So Bill, would you agree with that, that option traders really don't understand volatility very well? You're muted, Bill.
Right, yes.
So anyway, that's my experience, is that they really just don't have a really good understanding of what IV is and how to use it. So anyway, here's the slide. So first question is, what is IV? And it's a measure of perceived risk or uncertainty. So as you see, implied volatility go up, what you'll see is then there's nervousness, there's skepticism, there's worry in the market or uncertainty. So the VIX, the VIX, is the volatility index of the S&P 500. So that's most people look at that and say, what's the volatility in the market? But that's just one measure of volatility. And options are like financial insurance. So for those that live in Florida and probably even in Texas, premiums, IV or options are like insurance. The premiums will increase as the risk gets higher. So I live in Central Florida, and we have a hurricane season that kicks in probably around June 1st and runs through October. And as they get a named storm out there, if you went to purchase homeowners insurance, you're going to pay a higher premium because there's a risk out there. And so same thing with, like a financial storm, like an unknown, like CPI numbers coming out, or there's a big Fed meeting that's going to increase risk, and the price of options goes up. The other thing that's pretty interesting is demand for option increases when historic volatility increases unexpectedly. So after the market pullback yesterday, the VIX was up like 25%. So, while the market was down 5%, the implied volatility was up 5 times that. So options are going to really be impacted by implied volatility. So IV is really the value of that volatility as it's priced into options. So when you're looking at an option strike, what you're seeing is what the market makers have kind of built in based on what the price is, what is a fair price for that option. The other thing that IV does, it will calculate the future movement or a trend in the stock. So you can take a stock price, you can take its IV and multiply it, and that will tell you what is the expected one standard deviation move. So that's a pretty interesting feature of what IV can do. And so one standard deviation move is 68%. It means that 68% of the time it's going to fall within that one standard deviation move. And the Black-Scholes model is really the standard in terms of option pricing. So any questions about that so far? Okay, so here's just a really quick, you've seen these 100 times, I'm sure. This is basically the bell curve or standard deviation. So you'll see, 34% on each side makes one standard deviation. And then if you're interested, there's a 13.6% takes you to 2 standard deviations. So really, once you get past 2 standard deviations, it's going to cover like 96% of the movement in that particular stock. And this is something I hadn't considered, is that there's various states of the VIX. So most of the time, 70% of the time, the VIX is kind of right at or right below its all-time averages. So if a stock, has a 25 implied volatility, and that's the average, most of the time it's going to be sitting right at or even below that number, meaning it's kind of in a lull. And then following a lull is an expansion, meaning that the VIX starts to move up during some kind of a period of uncertainty. For example, if a stock has earnings at the end of the week, then as we go through the week, implied volatility is going to increase. It's going to expand because of that uncertainty event coming up. And then following that event, what you see is a contraction. And what happens is the stock will move, or the implied volatility will increase as we head into that event, and then it almost immediately reverts back to the mean. So, and that occurs about 20% of the time. So those are just things to be thinking of when you're looking at the VIX. And in terms of the VIX now, what stage would you guys think it's in now? Any guesses? Yeah, I'd probably say it's still an expansion. It's still moving up. And, once something settles down in the market, then we'll go into a period of contraction. So probably the reason you guys are listening is, why is this stuff important, right? I mean, VIX is good for us option geeks and stuff, but why is it important? So first of all, it's probably one of the most important factors in the pricing of options. So if you sell low IV options, then you're not going to be compensated as well for the risk that you take for that trade. So that's one thing. It's super important to know what the IV is when you're looking at a trade. So say, for example, you're looking at 2 separate put spreads, and we're saying, which one do we want to do? They're both equally as good based on the chart. If the IV is higher on one versus the other, we might get as much as 30% higher credit just based on the IV alone. So, so that's a good reason, right? We want to know. So here's kind of a quick calculation of how do you calculate the expected move. So the SPY at the time was at 416. I wish it was at 416 again. And the IV was 34.9. So to calculate the average move, the expected move on an annual basis, you would just take the 416 times 0.349. And that means that over the course of a year, that the S&P or the SPY would be expected to move up or down 145 points. So that means that somewhere the cone of expectancy would be between 271 and 562. So that's a big range, right? So, and it's a lot driven by a higher implied volatility. So if you're trying to calculate a period less than 1 year, all you do is you take that annual move, the 145 days, and you take the square root of the number of days divided by 365. So if you want to do 7 days, you just divide 7 divided by 365, calculate the square root of that, and then multiply it by the annual expected move. Any questions on that? So I thought that was pretty interesting to a way. I mean, most option chains tell you what the expected move is, but this is what it's based on. Okay, so that's why it's important. And so another big factor is when they state, what percentage of, what stocks are going to stay within that one standard deviation, these historical results are usually overstated, meaning that if you trade within that one standard deviation range and it says 68% are going to be within that range, it's actually higher than that, because historical implied volatility is almost always overstated. So that's a thing that we can use to our advantage. And there were some various, like SPY, 87% overstated. Gold was 79%, Apple 70. So so almost in all instruments, the range is overstated. So that means that the stocks generally don't move as much as the implied volatility indicates. And the other kind of really important factor is that implied volatility always reverts back to its mean. It's a mean reverting measurement. So remember we talked about the lull, the expansion, and the contraction. Well, the contraction is the reversion to the mean. And probably the easiest way, or the most dynamic way to see that, is if you ever trade earnings, or just look at an earnings trade, and you can see the day before they announce earnings, you can see some sky high implied volatility. And if you just look at the end of the day, the next day, it could be half of that in 1 day. So that's kind of an implied volatility crush. And the really good thing about volatility, if we're selling credit spreads or selling calls or selling put spreads, what happens is if the volatility reverts back to the mean, that makes the option price cheaper, meaning we make money just because of the IV reversion. Sorry. Does that make sense? So I've seen cases where a stock price really hasn't moved at all, but the IV reverts back to the mean and you hit your price targets. And remember, IV usually goes up when a stock sees an unexpected downturn. So that's why we're seeing IV now super high on every instrument. Any questions on that? That makes sense? Okay. So in terms of trading volatility, we want to sell options ideally when the the IV is higher. We don't want to trade a credit spread when IV is at its all-time low, because when IV increases, the price of that option goes up. So as sellers, we want to look for higher implied volatility. And if you think about it, if you do a $5 wide credit spread and you collect $1.50, for example, your max risk is only $3.50. Where if you collect $1, your risk is $4. So your risk is that your max risk is actually less when IV is higher. And so the other factor is knowing that they tend to overstate the expected range. So that's good to our advantage. And, you know, for covered calls, we want to sell calls after earnings before the IV collapses. So for the covered calls, that's what we're looking for. And then, so here's a few takeaways. So, and again, I think if you just remember these things, you're going to be ahead of 90% of the option traders out there. So IV is just a proxy for market risk, and it's derived by supply and demand and perceived risk in the market. And the demand increases when historic volatility increases unexpectedly, like yesterday. We had an unexpected drop, or I don't know how unexpected, but it went down a lot fast, right? And so IV went up drastically. So everything is, in terms of pricing, went up yesterday, you know, today, based on yesterday's movement in the stock market. And the IV can be used to calculate the expected range where a stock's going to move. And so if I'm looking at like a put spread, what I'm looking at, one of the factors is what's the expected move in the next 2 weeks. We want to be below that, right? So we don't want to be, we want to use that to our advantage. And so, and the normal distribution of one standard deviation is 68% on for the total, meaning 16% on each side. So, so that's kind of the standard deviation. And the book also shows that in actuality, it's always kind of skewed to the positive if you trade like a 16 delta strangle. So it's kind of like we're the casino, and we have the advantage based on the fact that we can sell using probabilities on our side. And so, you know, again, historic data shows that stocks stay within this expected move. And sellers of option, this is probably the key thing. Sellers of option have a long-term advantage over option buyers. And the reason for that is, in order to be profitable buying calls or buying puts, we have to be right in not only the direction that we bet, but also how fast and how much it moves. So say, for example, we buy calls in Apple, and Apple's at $150 a share. So we buy the 150 call and we pay $5 for it. In order for us to make money, that stock has to move more than $5 before our expiration. So not only do we have to be right in the movement, but right in the timing. Where selling credit, we just have to not be dead wrong. And the other thing that's interesting is that every stock or ETF has its own volatility profile. And that makes sense, right? If you're trading NVIDIA versus Procter & Gamble, they're going to be different. They're going to act differently, right? So, but they all have expansion and contraction. So, so that's another kind of key factor, is that, you know, just because a stock doesn't historically have super high volatility, it still can be traded because it will expand and contract and revert back to the mean. So that is my presentation. So any questions or feedback, mainly questions if you had any.
We have those slides available. I saw you put the PDF, the PowerPoint.
I did, yeah.
Okay.
Yeah. So, and again, after you read it, if you have questions, don't hesitate to shoot me a note. But I know this is a lot of heavy stuff on a Friday afternoon, and you guys are troopers to hang in there. And but I think it's so important. When I read through the book, I said, oh, this is the most important chapter in the book, because if you don't understand implied volatility, you're kind of shooting in the dark. Would you agree, Bill?
I think he's muted.
Yeah,
But
you're muted, Bill. But Bud,
Brian, it was even better the second time around watching this. It was reinforcement. Very
Wow.
good.
Very
good.
I'm always happy to talk. You guys know me enough to know that, right? So I never hesitate to do another presentation. So, but
you always keep moving, even when you get the deer in the headlights.
well, I mean, this stuff is really hard. I mean,
yes.
Most people, if you read a book on options, they rarely ever talk about implied volatility. And if they do, they'll just overwhelm you with statistics and, stuff. And to me, if you just kind of know what it is and how to use it to your advantage, you're going to be a much better trader. So that's why I wanted to share that with you guys. So I'm going to stop the recording and